Silver's price is screaming breakout, but the spread and the volatility market are warning that this move could get violent in both directions, and the people treating it like a clean, trendy rally are the ones about to get emotionally cleaned out, because the headline number isn't the whole market, not even close. The real market is the plumbing underneath it, margins, term structure, delivery timing, forced flows, and that's where the pressure is building. And by the end of this, you'll have a simple next week checklist, the levels that matter, the signals that confirm the thesis, the signals that break it, and why one calendar window can turn silver into a trap door or a slingshot. But first, you need to understand what volatility spikes actually means, because it's not just drama, it's math. When implied volatility jumps, the market is literally repricing the cost of being wrong fast. And in silver, being wrong fast is how portfolios get margin called and how dealers get forced to chase. That's the first hidden mechanism. Volatility isn't a commentary, it's a bill. And when that bill arrives, someone pays it, usually at the worst possible time. Right now, the basic context is simple. Silver has been trading around the low 90s per ounce in mid-January 2026 after a blistering run from the 70s earlier in the month with sharp pullbacks and sharp snapbacks that make the tape feel like it's breathing through a straw. And here's the key. When silver is living up here, every $1 move is not $1. It's leverage, it's collateral. It's risk limits getting hit, it's liquidity thinning out right when you want liquidity the most. And that's where the real pressure starts. Now, zoom out one step and look at the market's fear gauge. CME's Silver Implied Volatility Index, CVOL, built from options on silver futures, has been printing up in the 70s recently, which is not a little elevated. That's the market screaming. Expect big ranges, expect gaps, expect sudden repricing. And if you've never traded through a commodity with implied vol in that zone, here's the translation. It doesn't mean silver must go down or must go up. It means the market is bracing for violent discovery. It means the crowd is paying up for protection. It means dealers are getting more sensitive to every move. And that sensitivity is what can turn a normal push into a cascade. But that's not the part that matters most. The part that matters most is why this particular volatility spike is happening now in this particular window, and why the easy story is misleading. The easy story is always the same. Silver's up because inflation, or silver's up because money printing, or silver's up because industrial demand. Those can all be ingredients, sure, but ingredients aren't the oven. The oven is market structure, and the hidden detail in silver is almost never, is there enough silver on Earth? It's, is there enough of the right kind of silver in the right place at the right time in the pipeline that sets the marginal price? No, because silver can be plentiful in a headline sense and still be scarce in the only sense that matters for price discovery, deliverability, and immediacy. Now, think of it like water. A city can be surrounded by lakes and still have a drought if the pipes are clogged or the reservoirs are in the wrong place. That mismatch, wrong place, wrong time, is what makes silver a volatility machine. And when the market starts sniffing that mismatch, it shows up first in the stuff most people don't watch. Spreads, lease rates, premiums, delivery incentives, and the shape of the curve. Because if the front end of the curve starts acting like a scarce product, the market is telling you the near term matters more than the long term, and that's when squeezes are born. But here's the twist. You don't need a cartoon villain. You don't need to scream manipulation. You just need to respect incentives. Futures markets exist so producers and consumers can hedge and so speculators can take the other side. But when price explodes and volatility spikes, the exchange and the clearing system do what they're designed to do. They protect themselves. That's their job. And recently, the CME shifted precious metals margin calculations toward a percentage of contract value approach, meaning as prices rise, required collateral rises with it. Read that again slowly. The higher silver goes, the more collateral you need to hold the position, especially short positions that can face theoretically unlimited losses. That's not an opinion. That's a mechanical feedback loop, and it changes behavior. It makes stubborn shorts more expensive to maintain. It forces weaker hands to cover earlier. It can turn a normal rally into forced buying, and forced buying is exactly what volatility feeds on. Because if your position is losing money and your margin requirement is rising at the same time, you're not just bleeding, you're getting squeezed from both sides. The next detail is what flips the whole setup. This margin dynamic doesn't just punish shorts. It punishes anyone over-levered, longs too. If silver whips down a few percent in a day, and we have seen that kind of move, longs can get hit with variation margin. Risk managers can cut, and the same protect the book behavior that chases upside can also puke downside. That's why volatility spikes don't promise a direction. They promise a fight. And in fights, the winner is usually whoever isn't forced. Now layer the calendar on top, because the calendar is the catalyst that makes silver extra jump sensitive right now. Early January is not just a new year. In commodities, it's a window where passive funds and index trackers rebalance. This is one of those boring-sounding, massively important institutional processes where billions of dollars of futures exposure get adjusted because the index says so, not because a human suddenly feels bullish or feels bearish. It's forced flow, and forced flow colliding with thin liquidity is how markets gap. Bloomberg and other outlets flagged that investors were bracing for annual commodity index rebalancing that would drive selling of futures contracts worth billions. And whether that flow ends up being net sell pressure in the front month or spread pressure across months, the outcome is the same in the short run. Someone has to absorb it. Markets don't move on news. They move on the balance between forced orders and available liquidity at each price. And when silver is already running hot, the order book is already jumpy, and options dealers are already twitchy, those index flows can become the match that lights the room. But that's not the part that matters. The part that matters is what happens after the forced flow. Because forced flow is like a storm. While it's happening, you can't read the sky. But when it passes, the landscape is different. If the index selling hits and silver doesn't T-break, if it absorbs and holds key levels, that's information. It tells you there's real demand behind the screen, demand that isn't just retail hype. And here's a fascinating on-the-ground symptom that's been showing up. U.S. retail behavior doesn't look like a mania chase. Some reporting has suggested U.S. retail investors have been net sellers into the rally, while other pockets, overseas, institutional, or industrial channels, may be more active. That matters because when the marginal buyer is not the most fickle participant, trends can persist longer than people expect. But it also matters because it changes the nature of the risk. If retail isn't all in, the market can still squeeze higher, but it can also become more vulnerable to sudden air pockets because there is less sticky dip buying from the crowd and more professional risk management that sells when metrics trigger. And that's where the real pressure starts. Now let's talk a term structure, because the curve is the market's body language. In commodities, contango, where later months are higher than near months, often reflects carry costs, storage, financing, convenience yield. Backwardation, where near months are higher than later months, often signals urgency, demand for immediate supply, or stress in sourcing. You don't have to be a quant to get it. Contango says, we can wait. Backwardation says, we need it now. And silver, because it sits at the intersection of money-like fear trade and industrial input, can flip between those states quickly. When volatility spikes, watch whether the front end starts acting like need it now. Because if near-term spreads tighten, invert, or behave erratically, that's the market hinting at a real-world constraint. Not necessarily global scarcity, the wrong place, wrong time mismatch, the deliverable versus non-deliverable bucket problem. Here's the clean version of that mechanism. Inventories aren't just inventory. And some metal is in forms and locations that can satisfy delivery requirements or immediate industrial needs. Some is not. Some sits as eligible stock that's present but not committed. Some is registered and ready for delivery. Some is in coins and small bars that require refining and conversion to become useful for large industrial channels. And conversion takes time, capacity, and willingness. That's why you can see plenty of silver in one part of the ecosystem and still see stress elsewhere. And if you've ever wondered why premiums can behave oddly during big price moves, this is why. Because price can move faster than logistics. Price can move faster than refining lead times. Price can move faster than the willingness of holders to part with metal. And when the physical chain can't instantly respond, the paper market does what it always does. It rations demand through volatility. That's the part most people miss. Volatility is not a random mood. It's a rationing mechanism. But that's not the part that matters most for next week. Next week, the fight is going to be about positioning and reflexivity. Reflexivity means the market's own moves change participant behavior, which then changes the market again. Silver is reflexivity on hard mode because of leverage and because of the way options and margins interact. Let's do the simplest version without turning this into a textbook. When options implied volatility is high and price moves fast, dealers who sold options may need to hedge dynamically. If the market is in a zone where hedging flows are pro-cyclical, meaning they buy when price rises and sell when price falls, that can amplify moves. If gamma exposure is negative in key strikes, a break above a big level can force chasing. If gamma flips positive, the market can stick and mean revert more. Most people ignore this because it sounds abstract. Here's the translation. If the options market is loaded around big round numbers like 90, 100, then those levels aren't just psychological, they're mechanical. They can become magnets. They can become tripwires. They can become accelerators. Because if one level breaks, the math changes. And that's the key. The math changes fast. Now stack the proof points, because we're not doing single cause storytelling here. Proof point 1, price has moved into a regime where daily ranges are wide, signaling fragile liquidity and high sensitivity. Proof point 2, Implied volatility via CVOL has been elevated, meaning the options market is pricing bigger swings and dealers are operating with tighter risk tolerances. Proof point 3, the exchange has adjusted margin methodology toward percentage of value, which mechanically increases collateral demands as price rises and can force deleveraging or covering. Proof point 4, the calendar has a forced flow event, commodity index rebalancing, that can create temporary pressure unrelated to fundamentals. Proof point 5, there are street-level signs that the physical ecosystem is behaving weird, with some segments showing more selling than buying, and some forms of silver being slow to convert, which reinforces the idea that inventory exists doesn't mean deliverable supply is frictionless. Proof point 6, the macro backdrop is unstable in the exact way silver loves, a tug of war between real rates, dollar strength, and risk-off impulses that can whip sentiment intraday. And when all 6 stack, you get exactly what we're re-seeing. A volatility spike that feels like the market is being pulled by 2 strong hands in opposite directions. But here's the counterpoint that keeps this finance credible. Silver is not immune to demand destruction. In fact, it's uniquely vulnerable because it's not just a store of value narrative, it's an industrial input. If price goes parabolic, fabricators and manufacturers don't sit there like passive spectators. They respond, they thrift, they substitute where they can, they redesign, they delay purchases. And some recent commentary has pointed to exactly that risk. High prices can push sectors like solar and electronics to reduce silver intensity or shift to alternative materials in parts of the chain. That doesn't happen overnight, and it doesn't kill a squeeze in the short run, but it's the ceiling risk. It emiss how a rally that S right in the moment can become too far in the next phase, and that's not the part that matters until it suddenly does. Because if the market senses industrial demand is backing away, the narrative flips from scarcity to peak pricing, and silver can drop faster than it rose. That's the psychological trap. People think upside moves are slow and downside moves are slow. In silver, downside is an elevator, upside is a slingshot, and both can happen in the same week. So let's build your psychology shield right now, because if you can't handle the emotional warfare of volatility, the best analysis in the world won't save you. Silver's favorite trick is to make you anchor to a number. You buy at 92, it rips to 96, you feel smart, then it dumps to 88 in a day, and your brain starts screaming that the entire thesis is dead. And that's exactly when the market tends to punish you for panic decisions. The manipulation here isn't some shadowy villain, it's your own nervous system. Headlines will help. They'll hand you a storyline for every candle. Safe haven, demand fades, dollar surges, geopolitics ease, industrial demand wanes, speculators exit. It's noise dressed up as certainty. The discipline is to separate trend signal from noise. Trend signal is structure. Does silver hold higher lows above a key zone after forced selling? Does implied vol cool while price holds? Bullish digestion? Or does implied vol spike while price stalls? Warning of instability. Do spreads normalize or do they stay stressed? Do margin changes trigger cascades? Noise is a single scary headline on a single day. And the next detail is what flips the whole setup. In a volatility spike, being right about the direction is not enough. You have to be right about the path. Because even if the long-term thesis is intact, the path can still include a 10% air pocket designed to shake out anyone who sized too big or used too much leverage. That's why the only honest way to talk about what comes next is scenarios. 2 scenarios. Clean, simple. Scenario 1 is the controlled pullback and retest. In this path, silver can drop back into a prior breakout zone. Think high 80s as a rough area depending on where the market last based. Volatility can stay elevated but stop accelerating, and price can stabilize as forced flow and margin-driven liquidation finish. The confirmation here isn't it bounced once. It's it bounced and held. It's the market tried to break it and couldn't. It's spreads stop acting like a panic button. It's implied vol stops ratcheting higher. If you get that, the market is basically saying the supply of sellers is drying up and the next move higher is more likely to be real demand rather than pure squeeze. Scenario 2 is the continuation squeeze with gap risk. In this path, silver doesn't give you the polite retest. It churns, then rips, and the rip accelerates around big strikes and big psychological levels, especially as margin dynamics make shorts more expensive and as anyone underhedged scrambles. This is where you can see 100 become less a number and more a battleground. If 100 comes into play, you're not watching a chart. You're watching a risk management event, because at round numbers, the options book matters more, the media attention spikes, and liquidity can actually get worse, not better, as market makers widen and protect themselves. The confirmation in this squeeze scenario is speed plus follow-through. Fast moves that don't fully mean revert, closes that hold, and a tape that feels like it's stepping up rather than exhausting. The invalidation is also simple. A spike that immediately reverses hard and fails to reclaim. That's often the sign that the move was mostly forced, and once the forced participants are done, there isn't enough real demand to sustain the altitude. And that's where the real pressure starts. Now here's your near-term roadmap for the next week or two. No prophecy, just a checklist. 1. Watch the obvious levels, because obvious levels are where forced behavior clusters. Around the high 80s is a rough line in the sand zone for whether this is a healthy retest versus a deeper unwind, and around 100 is the psychological ceiling that can turn into a trigger if breached with momentum. Don't worship the exact numbers. Watch how price behaves around them. 2. Watch implied volatility directionally. If price is stable and implied vol is falling, the market is calming, and that tends to support constructive continuation. If price is rising, but implied vol is also rising, that can be bullish in the short run, squeeze behavior, but it also screams instability. It means the market is paying up for protection even as it rises, which is classic. This could gap either way. And 3, watch margin and risk control headlines, because changes in collateral policy can force position reduction independent of belief. 4, watch the curve. If near-term tightness persists, if the front end keeps acting urgent, that supports the wrong place, wrong time thesis. If the curve relaxes, it's a sign the market is finding supply and the squeeze risk cools. 5, watch cross-market behavior. Gold-silver ratio moves, dollar strength, real rate expectations. Not because they explain every tick, but because they tell you whether the macro wind is at your back or in your face. And 6, watch physical symptoms with a skeptical eye. Premiums, availability chatter, dealer anecdotes. Treat them as tells, not gospel. Because physical markets are fragmented and one shop's experience isn't the whole world. But when multiple independent signals line up, when the curve tightens, implied vol spikes, margins rise, and price refuses to break, that's when the thesis gets teeth. But if one of those pillars cracks, if price breaks key support and spreads relax and implied vol stays elevated, then we're looking at something else, a volatility event that S unwinding, not building. That's the difference between a trend signal and noise. And here's the final piece people always forget. Volatility will be used against you. If you're finance-minded and skeptical, you already know institutions don't have to rig anything to win. They just have to survive longer than you. They size appropriately. They hedge. They don't let a single candle decide their identity. The market's job is to make you emotional. Your job is to make yourself boring. That's not a meme, it's edge. And if you're still listening right now, you're not here for the dopamine hit of being right. You're building a process. You're watching mechanics, not headlines. You are the kind of person who can sit through a nasty shakeout without hallucinating a new worldview every hour. Keep that energy, because silver is going to try to take it from you. So here is the clean wrap. We are in a regime where silver is elevated around the low 90s after a rapid run. Implied volatility has spiked into a danger zone that prices big swings. Margin methodology changes can mechanically increase pressure as price rises. The calendar has forced flows that can distort price temporarily. The hidden detail isn't a simplistic shortage story. It's deliverability, timing, and the mismatch between inventory exists and inventory that can hit the right pipe right now. In the base case path, you get a controlled pullback and retest that holds, volatility cools, and the market proves it can absorb forced flow. In the squeeze case path, you get continuation with gap risk where big levels act like tripwires and the hedging math can amplify. Either way, the mission is the same. Watch the structure. Respect the path, don't let volatility turn you into a forced seller, and keep your focus on what would actually invalidate the setup instead of what feels scary in the moment. And if you want to roll with a community that treats silver like a market, spreads, margins, curve, flows, instead of a bedtime story, you already know what to do.